Welcome. So good to see everyone. I'm Jennifer Tim, Real Estate Wealth Advisor, and welcome to your midweek market brief for coastal Southern California. This is where we cut through the noise and focus on what actually matters: the data, the trends, and the opportunities in today's real estate market. Because here's what we do know: the headlines may change weekly, but the data leaves clues. And those who follow it are the ones that can move ahead. So today we're going to take a look at what happens nationally, and then we'll look a little locally and what it means for you and your real estate plan, because your legacy begins with a real estate plan. So let's start with what's happening at that national level. Definitely a lot in the headlines. So let's actually just have a look at the realities. So what we do know is that mortgage rates are spiking, but the housing demand has definitely not broken. So mortgage rates jump back up. They're sitting at a 30-year fixed rate of about 6.49, up 13 basis points in a week. And the reason why, I think we all know that, it's because oil has climbed above $100 per barrel, and treasury yields rose as markets priced in more inflation risk tied to that Iran conflict. The Fed is on hold. The Federal Reserve kept the policy rate at 3.5% to 3.75% in March, which of course is the Fed rate, not mortgage rates, and projected higher near-term inflation, which reinforces a higher for longer rate backdrop. Spring buyers are definitely feeling that squeeze again as those higher rates actually raise their monthly payments. So the lock-in effect is still alive. More than half of our outstanding mortgages are below 4%. And we're just basically seeing that those sellers have very little incentive to sell into today's 6% financing environment. Inventory is improving, but that's really slowly. Active inventory is up 5.6% year over year, giving buyers more options, but the pace of recovery definitely has slowed. Prices are softening at the list stage. So the median list price is down 2.3% year over year. And again, this is a national outlook, marking 21 straight weeks of flat or negative annual list price growth. And price per square foot fell 2.6%, the lowest in Realtor.com data back to 2017. So homes are taking longer to sell, and the average is about 4 days longer. Demand is weaker, but it definitely hasn't gone away completely. Mortgage applications fell 10.9% week over week, yet the purchase index still rose 1%, and the pending home sales increased 1.8% in February. Builder signals are mixed. Builder sentiment ticked up to 38, but new home sales plunged in January, showing that affordability pressure is still slowing the market. So there is an important inflection point. Housing Wire, one of the sources of data that I use, because I really trust the economists that they have at Housing Wire, they noted that demand is still growing with rates above 6.25%, but historically the market gets more fragile as rates move closer to that 6.64% and above. So looking at our mortgage rate watch for today, this is from Mortgage News Daily. So that is sitting at the 6.48%. We mentioned 6.49. It dropped slightly. And this is as of around about noon today, Eastern time, where they published this report. And basically, rates eased despite the conflicting Iran war headlines. And so part of the problem is, we're seeing, yes, there's a negotiation, no, there's no negotiation. Yes, there's a ceasefire, no, there's no ceasefire. So as far as the rate market is concerned, the most important development has been the general appearance of a shift towards diplomacy and resolution, and that is giving a little bit of confidence back to the market. So our smart money insight is this is not a broken market. It is a sensitive market. Buyers are still active, and every jump in rates changes behavior fast. So the spring market is being shaped less by headlines alone and more by the math of monthly payments. Follow the spread between rates, inventory, and list prices. Right now, inventory is up, list prices are softening, and pending sales are still finding traction. That tells us the market is bending, but it is definitely not collapsing. Waiting for that perfect condition is still risky. If rates retreat again, sideline demand can re-enter quickly. If rates stay elevated, well-priced homes in strong markets will still attract serious buyers because supply remains constrained. So bottom line, excuse me, smart money is not trying to predict geopolitical headlines. Smart money is watching whether affordability worsens. And right now, the market is volatile, but it is absolutely still functioning. Oh, excuse me. Now let's bring it closer to home because real estate is local, and this is where strategy really comes into play. So Capistrano Beach, we have a market action index of 37, which has gone up. Our median list price has gone up. It's now just under the 3.5 million mark. Price per square foot is up to 1,377. Our inventory has gone down to 12 homes, and our median days on market has gone down to 84 days. So the smart money insight, this is a tight inventory, selective demand market. So buyers still have room to negotiate on overpriced listings, but shrinking supply means the window may not stay open long. Sellers who price sharply now can capture demand before the next move up. Data point, a slight seller's market at 41. Our median list price just under that 3.5 million. Price per square foot has gone down slightly, $1,606. Inventory of 39 homes up slightly, but still nothing like it has been in previous years. And our median days on market is down to 42. So we do know that price reductions remain present at 21%, but they're not extreme price reductions. Data point is showing early re-acceleration, and the market is tightening before prices have fully responded, which often creates opportunity for buyers who make a move now and sellers who actually position themselves ahead of the market. San Clemente, our median list price is down slightly, 2.799 million. Our market action index is down slightly as well to 44. Price per square foot up to $900, and inventory 71 homes is up. Median days on market up slightly to 85. San Clemente remains a high velocity coastal market. Even with a little more inventory, homes are moving quickly, especially in the more attainable segments. This is a market where buyers need to be decisive and sellers still have leverage if priced correctly. San Juan Capistrano, our median list price is down slightly, 2,790,000. Market action index is down slightly to 43. Price per square foot, 812. Inventory, 45. Median days on market is 50. Our smart money insight is, and I see I have an error in there. I apologize. It's 24% price reduction suggests that buyers are still price sensitive. San Juan Capistrano is a healthy pause, not a downturn. Inventory has expanded. Demand is still absorbing homes quickly. Buyers may find opportunity in listings that overshot their price, while sellers that position themselves well are going to attract those buyers pretty quickly. Neighborhood deep dives, watch your feed for the other market areas that we monitor. In our global perspective, I thought this was a prudent time to have a look at geopolitics, inflation, and the Iran war and what that does to real estate. Well, point number one, real estate is not directly impacted, but it is financially impacted. Wars really impact real estate directly. The real impact comes through oil prices, inflation, interest rates, and that consumer confidence. So the insight there is real estate doesn't react to war headlines. It reacts to money, debt, and confidence. Number two, the point, oil. Oil is that trigger. And oil prices have surged 25% since the conflict began. I'm sure we've all seen that when we have been at the pumps filling up our vehicles. The Strait of Hormuz carries 20% of global oil supply. Higher oil equals higher transportation, construction, and living costs. Real estate specific impact is higher construction costs. So steel, cement, materials is definitely rising. Increased cost to build means that there's going to be less supply and long-term upward pressure on those prices. We tend to find that, we know what's going to happen. It's basically an inflationary response. Number three, speaking of inflation, interest rates and housing activity. Rising oil equals rising inflation fears. Inflation pushes bond yields and mortgage rates higher. Central banks globally may delay rate cuts or consider hikes. And if you think about where we were with our mortgage rates prior to the war, we were basically sitting below 6%. So we've definitely seen those increases. Global pattern emerging, buyer activity slow short term while everyone figures out is there going to be an end to this war anytime soon. Sellers hesitate, which means the inventory is tightening. And markets become very rate sensitive, but not demand free. So our global perspective, smart money insight. Global real estate is entering a volatility window. It's not a collapse for sure. The fundamentals remain: housing shortages, population growth, long-term demand. And the biggest mistake globally right now is trying to time geopolitical events. Just like domestically, if you're trying to time the perfect conditions, chances are that you will not be successful. So as one economist noted, shocks like these are exactly why timing the market is so difficult. Different conditions can shift in an instant, honestly, hour to hour. So our wealth building insight for today: real estate remains one of the most consistent drivers of generational wealth. Wealth is built through time in the market, not timing the market. So essential right now. Even in shifting markets, equity continues to compound over time. Today's market rewards those with a clear plan, not perfect timing. So the families who win are the ones who stay in the game with a strategy. So wealth building insight, smart money, it's not waiting. It's watching inventory rates and demand patterns. While headlines focus on uncertainty, the data shows demand is still active. Windows of opportunity open when prices soften, but demand remains. Strategic buyers and sellers act before the next shift, not after, because we already know that normally by the time you've predicted that next dip or rise or crest, it's already happened and you've missed that opportunity. So uncertainty creates hesitation for some and opportunity for those that follow the data. As a real estate wealth advisor, I follow the data. And so let's talk strategy. Feel free to DM me if you would like to figure out what your home is worth right now, what your capital gains tax liability could be, or if you've got investment properties, we're honored to do an asset performance test to truly see how they are performing. Because what does all of this mean for you? So as we wrap up today, here's what I want you to take away. And let me move on to this next slide while I say this. The market is always moving, but not always in the way the headlines suggest. We're seeing shifts in inventory, adjustments in pricing, and continued demand, just behaving differently. And this is exactly why having a strategy matters, because whether you're thinking about selling, buying, investing, or planning for the future, it's not about waiting for the perfect moment. It's about making informed decisions that support your long-term wealth and your family's future. If you're curious about what this means for your situation, or you'd like help creating your own real estate plan, I'm always here as a resource for you. So thank you so much for joining me today. And remember, your legacy begins with a real estate plan.